Joining me here, Post 9, Rich Saperstein of Treasury Partners, just ranked number 4 on Barron's top 100 financial advisors of 2023. Congratulations, my friend.
Thank you, Scott.
It's nice to have you back. We're just parading all the bears through today, I guess. You laugh because you have been bearish. Roadkill. Bears have gotten run over.
Well, I think it's more nuanced than that because, Scott, we always own equities. But the opportunity this year was a once-in-15-year opportunity in the muni bond market where we added tax-free bonds, 4 to 5% yields, locked in for out to 10 years. And look at what that does for a portfolio. If the economy slows, which we think it will do, rates will go down, and these bonds will go up in value. And you can look at what happened last month, where we had a move in the bond market we hadn't seen in 40 years.
So you managed $9 billion for clients. You made some of the right moves, obviously, or you wouldn't be number 4 on the top 100 financial advisors list of 2023. Munis clearly worked well for you. What'd you miss in the stock market, and why?
We were overweight big tech. And so I don't look at it as missing or getting, because if you look at the 2-year return on the S&P, it's 3.1%. The Mag 7 2-year return, 2.6%. So we're not looking at shorter periods of time. We're really looking at extended periods of time. And right now, we think stocks go higher. We're not looking to change our asset allocation because
but you told me that you had. Now, you tell me if this has changed. You've maintained throughout the balance of this year, you can correct me if I'm wrong, that you've had more cash than you've ever had. Is that true?
Deployed into bonds.
All deployed into bonds.
Yeah, we're chock full of munis, and we just caught an amazing run in interest rates in the last 6 weeks. You saw the 10-year went from 5.20 down to 4.
Historic move in bonds.
Exactly.
I mean, November, the best month, I think, since the 80s.
Correct.
I totally get it. What allows you to be more positive equities?
Show me the earnings, Scott. We have
wait till earnings season.
Well, we have a 245 estimate for next year. We still have so that's an 11% increase. We still have the lag effects of the Fed's tightening that are still slowing the economy. So the real question is, will we see the earnings come in at 245 next year? So what will cause me to turn? I think the inflation thing is pretty much controlled right now. The Fed pivot is a positive. That's why we think we're going to see rising stocks next year, especially in the first quarter. However, there's consensus on soft landing, even though housing is slowing. There's tighter credit spreads. Everybody's marching in the same direction. So I think that's one concern that we should all think about.
I mean, I'll give that to you that, let's just say, for the last few weeks, sentiment has clearly changed to a degree where there are a lot of people on the same side of the boat.
Yeah.
However, gosh, there's so many bearish people still. There's so many bearish people out there. I don't feel like we are in some raging new bull environment as it relates to sentiment necessarily. Do you?
Well, with multiples right now, we're at, 19.3 times next year's estimate. It's fairly elevated. Although when we look at earning, the PE ratio with 30% of the market in the Mag 7, you're going to have a naturally higher multiple than we had historically over the last 20 years.
Well, I mean, if the economy remains resilient, we discussed it just in the last segment. If the economy remains resilient and interest rates continue to come down, earnings are going to hang in if those scenarios happen.
Yeah.
Theoretically, that supports higher multiples.
I think that's a big if because, look, we still are chock full of stocks, and now we have our munis. But the big if is if the economy slows not hard enough, in which case we can see earnings get to 245 while the Fed is in a more moderate campaign right now. So a lot of things have to still come into place. I don't think we're out of the woods in 2024 on economic landscape.
In terms of the Fed pivoting, do you feel like that is as significant as it seems to be? In other words, if I asked you...
The answer is no, by the way.
Well, if I asked you before they started tightening, hey, Rich, these guys are going to tighten 500 plus basis points in 17 to 18 months, you'd say that is undeniably a negative. I don't want to be anywhere near the equity market. Now I'm telling you they've pivoted and they are going to cut significantly next year. Why can't you tell me at that moment then, you know what? I want to be overweight U.S. equities relative to my muni positions and any other asset class?
I'd listen to what they say, but I wouldn't follow the futures market, which has been wrong because the futures market in January was calling for Fed rate cuts in July of this year. So the futures market is overstepping where the Fed actually goes. I don't see the Fed cutting until second half of the year. And then, as your prior guest said, are they cutting because they could or because they have to is one of the questions. But
aren't we kind of getting towards that answer that they're cutting because they can?
That remains to be seen. Again, unemployment's low, right, which is a positive. So they could cut as long as the inflation keeps coming down.
I think we'll leave it there. Number 4 on the Barron's Top 100 Financial Advisors list of 2023. We'll see what 24 brings, my friend.
Thank you very much, Scott. Happy holidays.
Saperstein joining us with Treasury Partners.